So you have probably heard of this stock investing thing before, but you have put it off for some reason. Maybe even had preconceived fears about investing being too daunting, too complicated, too risky, to insert adjective here. Don't worry, you're not alone. And this is exactly what motivated us to create this video, a guide to understanding the full breadth and reasoning behind investing. Hopefully, after you are done with this video, you can share it to anyone that has questions about investing as a beginner. This video will be structured into three parts: the why, the what, and the how behind investing. So first things first, I understand that we all come to the table with our own set of assumptions. And if I can guess, many of you might think that investing only means picking the next stock that could potentially 10x your money from say $10,000 to $100,000. So that might be true to a small segment of investors. But in general, a much broader sense, this might not be the best way to describe investing to someone new. Let's reconstruct your entire understanding around this whole money game. So let's first try to understand the motivations, specifically the why behind investing. Why bother? Can I get by life without investing a single cent at all? I think the answer is probably yes, but with a few caveats. See, here's the typical life cycle of a fellow human. From 1 to 18, you probably don't know what the heck you're doing. You're a dependent, basically relying heavily on someone else to take care of your well-being. And this role is often fulfilled by your immediate caregiver. He or she gives you a place to stay, gives you food to eat, gives you clothes to wear. You're not necessarily delivering any sort of value other than your cuteness or just you being cute and existing. So after crossing the age of 18, you slowly lose this cuteness status and you're required to start fending for yourself. You'll be exchanging your time or skill sets or both in exchange for financial resources. And this grown-up stage that we like to call it can last for any length of time until you either choose to stop voluntarily working or until the day your body can no longer take it, which is an unfortunate fact. And the last stage, hopefully, is when you've accumulated sufficient amount of financial resources that you can spend down for the rest of your life, especially when you no longer bring in any forms of cash flow. So in traditional terms, we call this last stage the retirement stage. Now, circling back to the idea about not investing. So you can probably do so in one of two scenarios. In the first scenario, it's when you do not need to be bothered about the last stage of retirement. Second is if you earn so much money in your adult years that you don't really have to worry about retirement, even if you don't put your cold hard cash under your bed. And of course, the third most common scenario that we forgot to mention is if you have a money printer at home that can let you print money on demand. FBI, open up! Of course, I'm just joking. I don't think owning a money printer is that common after all. Anyways, to make matters worse, there is a structural disadvantage built into the system working against us. So it's the first finance concept that I'll introduce in this video. It's called the time value of money. In short, it means that money today is much more valuable than the same amount of money in the future. So to illustrate this point, I love to show this infographic from Visual Capitalist. So it outlines the purchasing power of the dollar currency across a 100-year time period. In 1913, $1 can buy you 30 Hershey's chocolate bar. In 2020, roughly 100 years later, it can get you one mini-sized McDonald's coffee. And the main culprit for this phenomenon? Inflation. So for those not living under a rock, you have probably felt the effects of inflation over the past few years. In general, inflation is a good thing because it spurs demand and it's a telltale sign that it's a growing economy. But it has to be moderate and controlled. Too much inflation might result in a loss of confidence and social unrest. So that's not a pretty picture either. We want inflation, but we don't want too much of it. But do you know what we can't get enough of? The like button, of course. So do remember to give as many likes as you can, in case you have forgotten. Now, another factor that contributes to the time value of money is the concept of opportunity cost. So if you get $100 today, you can immediately put it in a savings account, invest it, or even lend it to someone to earn more money over time. By the next year, it will probably be worth more than $100. However, if you've only received the $100 a year later, you're missed out on all these opportunities to gain this so-called additional money. Hence, the name opportunity cost. So in case you haven't realized, if you don't start investing your money and just leave it in a bank alone, its value and purchasing power erodes away every single year. Now that we have covered the why of investing, moving on to the what of investing. So what exactly is investing? So if you were to follow the Oxford definition, it is to put money into financial schemes, shares, property, or a commercial venture with the expectations of receiving a profit. So that's too many English words. In layman terms, it just means to use money to make more money. So as a quote from legendary investor Warren Buffett succinctly puts it, if you don't find a way to make money while you sleep, you will work until you die. And you must learn the rules of this capital game. And I think it's essential to understand the relationship between these three key drivers: time horizon, rate of return, and capital size. So personally, I coined them the holy trinity of investment returns. So you need at least two of these three factors to achieve great investment results. And to illustrate my point, if you have a large enough capital size with a decent rate of return, you don't need a long time horizon to make good returns. Purely because even a 5% return per annum on a 1 million investment is $50,000 a year. And that's probably enough for many people, myself included. On the flip side, if you have a decent capital size with a long enough time horizon, even without a high rate of return, you'll still come out okay. Think about it, a $400,000 investment at the start with a 2% CAGR over a period of 50 years, you will end up with more than $1 million at the end of that period. So in case you're wondering what CAGR stands for, it's the short form for compound annual growth rate. Basically, the rate at which the investment grows every year. Now, in the last scenario, if you don't have a big capital to begin with, but with a decent rate of return and a long enough time horizon, you'll still be okay. Take for example, you'll start with $10,000, compounding at a rate of 10% CAGR for 50 years. You'll end up with more than $1.1 million. And now, if you were to compare the three scenarios, the most potent outcome would be a result of a long enough time horizon coupled with a respectable rate of return, even if you were to start off with a much smaller capital size. And this is the second finance concept I'll introduce in this video, the power of compounding. Sometimes, when we set a financial goal for ourselves, we always feel like it seems out of reach, especially when the number is huge. More often than not, it's because our monkey brain is accustomed to think linearly rather than exponentially. The secret? Investing actually allows you to compound exponentially. So let's say you start with a capital base of $100,000, compounding at a rate of 10% per year. In order for you to double your money from $100,000 to $200,000, it will take roughly 7.3 years. How about the next 100,000 from 200 to 300? It will shorten from 7.3 to 4.3 years. The next 100,000, 3 years. And the next 100,000, 2.3 years. So I believe you know where I'm going with this. So with compounding on your side, you don't just earn on your initial investment, but also earn on the returns you have already made. The bottom line, it pays to start early and be consistent. So now that we have a better understanding and appreciation of why investing is so lucrative and how money helps you make more money, let's get to the implementation. How do you start investing? So before you even choose which instrument or what vehicle you want to put your money into, I think it's important to do a self-assessment exercise. You need to know yourself, and more importantly, you need to know your current situation. So I know investing usually sounds extremely exciting at the start because you cannot wait for your money to grow faster and to grow bigger, and of course to expound on this entire idea of compounding. However, that couldn't be further away from the truth. In order for that compounding to happen, you need to stay in the game, and you need to stay in the game long enough. The last thing you want is to be forced to sell when the investment is not doing well, for whatever reasons. Therefore, you need to first take stock of your current situation. So are you ready to invest? Do you have enough funds set aside for any emergency or to weather any surprises? Do you have any high interest debt drawing away your cash flow? And are you sure that you have money to commit to a consistent investment plan, etc., etc.? So after fireproofing your external financial situation, you then need to look inwards into your own personality and goals. What do you want to achieve? What can you expect? And what are you good at? So we have previously made a video outlining the different investment strategies, and that would serve as a good starting point for you to look at what is suitable for you. Now, there are many options out there that can help you achieve your desired rate of return, but they all come with their own set of pros and cons. And in the investing world, stocks and bonds have the lowest barriers to entry. And in this investment guide, we'll just focus on stocks. And the million-dollar question is, what is a stock? So instead of thinking that you are buying a ticker symbol on your screen that goes up and down, green or red, a stock actually represents a part ownership of the underlying company that they represent. So when you buy a stock, you're actually buying a piece of a company, albeit a very small piece. And as an owner, you benefit if the company does well. On the flip side, there is also risk built into stock ownership, where the company could go bankrupt and you'll lose your entire investment. So I can already hear people typing away, asking in the comments below. So what stock should I buy? Tesla, or Nvidia, or Microsoft, or Apple? Or maybe even a stock that my friend just recommended to me last week. Should I buy that instead? Hold your horses, my friends. So for a general rule of thumb, especially for those that just started out their journey in investing, the quote-unquote textbook answer is to first gain exposure via an ETF. So what is an ETF? It's an exchange-traded fund. In short, it is a type of fund that holds a collection of assets. So when you invest into an ETF, you are investing into a range of assets rather than just buying one company or one stock. And this helps you diversify your portfolio. So why only buy Microsoft or Apple or Amazon when you can buy all of them? You are basically spreading your eggs into multiple baskets. You are not afraid of one or two or even 10 companies performing poorly. If you hold 200, 300 or even 500 companies via an ETF. So the gold standard in the world of ETFs is the one that tracks the S&P 500. So why is it so good? Because through one instrument, it gives you exposure to 500 of the largest publicly traded companies in the US. And by extension, many of these large companies are one of the best enterprises in the world. So if you had to ask me personally what I buy, I actually do adopt a dollar cost averaging approach into buying VOO monthly. So VOO is the ticker of the ETF that tracks the S&P 500. So if you're interested in understanding this thought process or just this idea of a dollar cost averaging approach, I can talk more about it in another video if there's enough interest in the comments below. Now, circling back to the idea of owning the top 500 companies in the United States, it gives you comfort knowing that your money is being parked with some of the best enterprises in the world that has a global footprint. So they are helping you get a return on your capital compared to just stuffing the money under your pillow. The best part, this ETF has a special superpower. It allows them to kick back companies out and add in new potential up-and-coming strong companies, depending on a few set criteria. And the result? Referencing the 100-year performance of the S&P, you can see that it goes in only one direction, which is to go up. Of course, there were multiple periods of weak performances, but the key to long-term, successful investing is to be able to weather out the volatility and to constantly stay invested. And if you were to go back to the foundations of investing, why should you invest? It's not solely about growing your money, but it's about protecting it from the hidden cost of inflation and missed opportunities. So by investing in a strong, well-performing index, you can tackle both challenges. And when you invest, you are getting a stake in some of the best companies out there. Remember, owning stocks means you own a piece of a business. These businesses have the power to raise prices even when inflation hits, boosting their revenue and profits, which in turn benefits you as a shareholder, despite you crying in the real world, thinking everything around you is increasing in prices. But that's not all. These companies are always on the lookout for new opportunities to grow and create more value for shareholders. So I hope that this video gives you a solid foundation as you take your first step into the world of investing. Remember, investing is a journey and getting started is the most important part. If you are ready to take your investing game to the next stage, be sure to check out the links in the description below. You'll find resources, tools, and more guides to help you beef up and grow your knowledge and build your future. Now, this is CK from Piranha Profit signing off. Till next time, keep winning.